Okay, so in summary, statistics look bad, but they're a lagging indicator. So the market, what we're seeing is activity is returning. Things are sort of getting back to normal, and we expect things to recover as we get into next year. What about sublease space? What we've seen, Dallas-Fort Worth always has several million square feet of sublease availability. That number inched up to about 9 million square feet during the pandemic, and it sort of stayed there. There's some signs it might be inching down. But what are you guys seeing in terms of sublease trends?
So that number is starting to come down a little bit, which is great. Subleases, last year for a lot of my groups, my tenants, it was a great short-term Band-Aid solution. So it gives you an opportunity to move into a space. It's already built out. It's got the FF&E. It's at a discounted rate. And a lot of times it's a shorter term than on a direct basis. And so for last year, that was a great solution, and this year as well. But I think they're starting to come off. I think people are coming back to the office. AT&T went back last month. JP Morgan in Dallas is going back 50% July. I bet you by, call it September 1, once we get past the summer, we've kind of solved, kids are back in school, you don't have to worry about daycare. I think we're back to 85, 90% back in the office in the Dallas market. So one of the results of subleases, and Sarah touched on it, is that the landlords, what they've had to compete with is not just cheaper space, but it's the ready-to-go space. So a lot of the smart, forward-thinking landlords have built out some spec suites. So they're already built out, they're ready to go. It allows a tenant to move in quickly and kind of bridge that gap to give that short-term solution.
Yeah, I'll just add to that both what Sarah and Billy said, I think it's what I've seen is, and what I've heard from some of my peers in the industry, is that the biggest squeeze is being felt on those 25,000 square foot and below tenants. And if you look at the numbers on that, it's 2/3 of the sublease availability is under 25,000 square feet. So it's a pretty significant amount of the space that's available that's competing with those smaller, more move-in ready spaces. Almost everybody across the board right now, if you don't have spec suites, you're building them out right now because, and not just in the 2,000 and 3,000 square foot range. People are building out as much as 10 and 15,000 square foot blocks of space that are in some sort of quasi move-in ready state, if not fully built out and ready to go. And that's just to be able to compete with those subleases. Another thing I'd say is the higher quality subleases, if you really look at the deals they're doing, it's not that necessarily that different from the rate that they probably signed in the last few years. So it's really not a huge discount over the direct rate that you may be getting, and the tenants are having to live with the terms that someone else negotiated. So if it's a really long-term sublease of 7 or 10 years that you're taking down, you're having to live with someone else's deal that they cut, and that's not super palatable if you're paying a top of the market rate.
I think Billy's right about return to work and what's going to happen at the end of the summer in September. Calvin Schnorr, economist with REIT, put out a good piece in Forbes over the last couple of days. And I think we all kind of know the companies that have been pushing off that return to work, they've set September as kind of the last date. I don't know of anybody that's coming back any later than that. So that return to normal and return to work is going to take a leg up.